Many people like to talk about where we are in the cycle and what one can do to protect themselves from rising interest rates or rising cap rates, and how maybe they are underwriting differently, more conservatively or more aggressively. But I think really those things are foolhardy, because the future, as we all know, is so difficult to predict, and it's really not, in my opinion, worth trying to embed future predictions into your underwriting that are so far outside of your control. These are really macro ideas, macro bets, and as a real estate investor, you should really focus on your niche and the things that you can control, which would be things like your renovation budget, your pro forma rents, your occupancy, and your expenses. So the concept I want to introduce to you or share with you today is this idea that throughout the cycle, yes, of course, there are times where it is more advantageous to buy property, and there's times where it is more advantageous to sell property. However, predicting when that is extremely difficult. People thought that we were at a top of the market in 2015, and that proved to be very incorrect. And today, people think we might be at the top again, and that may prove to be incorrect yet again, right? We really don't know. And rather than changing the way you underwrite based on where you think you are in the cycle, you should underwrite consistently, in my opinion. So even if you have a hunch that, hey, I think that there's going to be cap rate compression or there's going to be cap rate expansion, you should stick to your principles and your philosophy as far as what you just regularly do with your exit cap rate, for example. For us, for example, we identify what the market cap rate is on a comparable, stabilized basis for what we're going to sell, and then we apply a roughly 50 to 100 basis point expansion on that cap rate to derive our exit cap rate. And obviously 50 to 100 bips is a big range, so there's variation there, which provides a lot of leeway, but that's our general philosophy, and we're not necessarily going to tighten up that expansion if we think that there's more cap rate compression left to be had in the cycle, or conversely, beef up that expansion and be extra conservative because we think that there may be a recession ahead or something like that, right? I think static or consistent underwriting is the way to go. So what do we actually do to adjust, or what should you do to adjust? Because obviously you should position yourself advantageously based on where the market is today, right? And the answer to that is you shouldn't change the way you underwrite, you should change your strategy, you should change the types of assets you're buying. So I've seen a lot of smart people in the space shift from buying Class C property to more so Class A property in the last few years, because they've seen that the value in the Class C just isn't there quite as strongly as it used to be. And they're finding that the risk-adjusted returns are not as favorable. So that's something worth thinking about, and not necessarily that you should change the way you underwrite these new opportunities or this new market, but you should consider buying assets that are better positioned for where we are in the cycle. And that can change, and that has various reasons, or that there's various reasons for that, and it could even be independent of the market cycle. It could be due to investor demand, what's trendy. It could be that value add is really hot, and then there are other strategies like stabilized assets or development that are less demanded by investors, and so there's more opportunity. There's various reasons, and I think leaning into where there's more value and being nimble in that way is really the way to best position yourself over time and over cycles, rather than trying to change your underwriting and shift it around because you have predictions of the future. Thanks for watching.